The following is paid programming.
I'm a big fan of money. I like it. I use it. I have a little.
You want something more.
I keep it in a jar on top of my refrigerator.
Something more from your hard work.
I'd like to put more in that jar. That's where you come in.
There's gotta be something more. Gotta be more than this.
Whether it's financial planning, mortgages, insurance concerns, or those quality of life issues that make the money matters matter. Whatever is on your mind today, call Something More now, toll free, 866-771-8901. Come on, let's get you something more.
I still can't even hardly believe my ears when you even tell me this.
Gotta be something more.
Something More with Chris Boyd, certified financial planner professional, advising clients across the country. Here he is, J. Christopher Boyd.
All right, welcome back to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, here with Jeff Perry. We're both of Asset Management Resources, and thanks for being with us for the second hour of Something More. We love to talk about all matters financial and also those other matters as we talk about the things that make the money matters work. Money matters matter. I don't know. I'm getting tongue-tied. In any case, thanks for being here. We were talking before the break about the challenges investors have had when being invested in both stocks and bonds, the traditional 60-40 portfolio. And in a year which is abnormal, and it's not to say it's unheard of, I dare say unprecedented.
There you go.
Yeah, but it is not. It is not that it's never happened before. It has on occasion, but it is unusual. And when we did see in the financial crisis, when the financial system was at risk, pretty much all assets declined in unison in that scenario. If there's a terror strike or something like that, oftentimes you'll see a unified, shock to the investment markets and assets decline. Treasuries often will be a safe haven in those kind of situations where
Flight
people
to quality, right?
Yeah, that flight to quality.
Right.
However, what happened this time was, just to elaborate for a moment, we had the idea that the Fed had positioned the interest rate environment so artificially low that investors were almost forced to move toward more risk, equities, in this case stocks, because there just was not an opportunity for returns in fixed income or just about anywhere else.
Savers were complaining about it
for a long time, right?
Right.
So we've been in this environment for such a long time, we kind of forget sometimes that that's not the norm. Mm-hmm. And so in this effort to reduce inflation, to handle, mitigate the risks of inflation, the Federal Reserve declared it was going to raise rates. I just don't think most people expected they were going to raise rates so dramatically so quickly. So in any case, when that happened, a couple of things that, happened in unison. On the one hand, let's talk about stocks. There was a headwind for stocks when interest rates are higher. It costs more to borrow money, to operate the business in effect with, for cash flows and so forth. There's some higher costs. However, that's not really what the problem was. The real problem is that investors weren't willing to pay as much for future earnings in an environment when interest rates are rising so substantially, in part because there's alternatives where they might be able to go elsewhere.
Absolutely. The I bonds just demonstrated that, right?
Yeah, that's a great point.
Right, you can get this over here, so why take risk?
So then, as a consequence, investors said, I don't think I'm willing to pay as much for those stocks.
Right.
And therefore, the price to earnings multiple that people were willing to spend in a low interest rate environment, which was extended, began to decline. And now we're pretty much back to a 25-year average on the forward-looking PE ratio. So what the earnings are that people are expecting, the price is how many times a multiple of those earnings.
The most common way to value.
It's a very common,
stock, right?
shorthand for valuation, right? So,
Yep.
and so we're kind of in line with a more long-term average, but we were notably higher, one standard deviation away, perhaps. So, that strikes you as saying, okay, we went from 21, 22, I forget what it was, 20, 21, 22
yep.
times a multiple back down to like 16 or 17 times multiple.
Right.
Well, that takes some value out of stocks. Okay, that's what's happened with stocks on the one hand with the rising interest rates. On the other hand, bonds. When rates rise, when the Federal Reserve is raising the rate of interest on the short term, it had some impact for further a ripple effect down the yield curve as well, right?
Right.
Bringing rates higher. And as rates rise, existing bond prices decline. So we had, because of the severity of the raising of rates, it's not uncommon for the Fed in a given year to say, when they have an environment like, they want to slow the economy, maybe they'd raise rates 1% in a given year would be kind of like pretty aggressive back in the day.
Right.
We went up 4% or more, right?
That. Right.
It was extreme. And so bond investors really took it on the chin last year as well. So stocks and bonds were down double digits as a consequence. Now, what's different though? Bonds are paying a lot more today in the income. When we started the year last year, a lot of bonds were paying virtually nothing, very minimal yields. So when prices went down, I wasn't really getting much income at the start of the year.
Right.
That's changed. Now there's a lot of income that's coming in. So if prices fluctuate, I'm still getting a nice coupon, a nice income stream that's coming through that yield to help offset some of that price movement potentially. So, we still think, you and I were talking earlier in the last hour, that there's a possibility the Fed's still going to raise rates, maybe 0.5% in the first 6 months or something like that is probably what's expected, of 2023. So, there still could be some rate increases, but now you're getting a lot more income. So you can absorb some of that potentially, and there's an expectation that won't stay the case. It probably will start to turn the other direction. So shorter term bonds get the benefit of that more quickly, of that rising interest rate, and they get better yields, and the price is more stable because they mature faster and all that.
Right.
So not as much of a worry for the short end. But the intermediate term bonds have already started to see markets anticipate that rates may fall because we probably are, going to have this tight environment where it might cause a recession and
might be too tight.
Might
so
be
the Fed
too
will need
tight.
to take some off the top, so to speak.
And that might cause investment to change, in terms of the Fed's approach may change. At the very least, it'll sort of stop the tightening process. And if not this year, maybe next year, there's some expectation. There may be some softening of that, some loosening of that monetary policy, though I don't think we should overestimate that either, that the Fed's going to be racing back down to low numbers. You know what I mean? It's
I agree.
Probably going to be something near where we're at. So in any event, it's a very different environment, though, is the bottom line for, particularly the bonds. You probably have some things to add to what I just said, Jeff, but when it comes to the bond investments, there's a lot. It's a much different environment today than it was a year ago.
Absolutely. It's a much healthier environment. It's a much more normal environment. We were talking off air, I think, last week, and I believe that this is a perfect position for bond investing to keep what you have. If you went through it last year, it hurt, but now, as you said, now you're getting the higher yield, the higher interest rate, and your bonds will continue to do that. So it's a good place to stick with. And if you're not in bonds and you want to take some risk out of your portfolio, in equity portfolio, you may consider adding some, because the yields are going to stay higher than they have been, certainly. And if that scenario works out as many market watchers are thinking it will, and you alluded to that later in the year, maybe 2024, rates start to come down a bit, not low, not like we were,
Right.
but then you're going to have some capital appreciation still at a decent yield return. So, it's very different than last year. I won't say it's the opposite, but it's very different from where we were with bonds, and kind of a, bond 101. If you own individual bonds, and you may think that you lost principal, as long as you keep the bond, you're not losing principal. You're gonna get your principal at the end of the bond. And your interest is going to be on when you bought the bond, whatever the rate was. So if you had any fluctuation in price on a bond, an actual bond that you bought, that's just a paper thing. You're going to get your money back, assuming whoever you bought it from is still around. If it's the treasury, you're going to get it back. And if you're in a bond fund, now is the time that you're going to get those extra yields. And if you're reinvesting those yields, you're getting, dollar cost averaging, which has a great benefit when you have a yield on a bond fund, because you're buying more shares when it's lower, which happened last year. That's what I was doing. I was adding to it, sticking with it and adding to it. And now I'm very happy with the position that I have because of those reasons I said. And so this discussion, we seem to agree, but I want to go back now, right?
Yeah.
Because the bonds, as we've described them, treasuries, corporate,
and
whichever.
we're speaking as though all bonds are the same.
I know,
we're
that's
talking
what I'm hesitating with.
But we can come back to that. But there's definitely nuance within that we're kind of painting with a broad brush in the way we're talking about it.
I know. So bonds. So if we're comfortable with bonds in January of 2023 now.
Yeah.
Let's go back to our conversation before the break to the 60-40, right?
Yeah.
Because as you said before the break, the 60-40 model portfolio, without getting into the nuances of what's included in that, just generally speaking, suffered because bond prices went down as yields went up. So how do you feel about the 60-40 portfolio in January of 2023?
Yeah, I think very differently, right?
Right.
And that let me just, you kind of referenced this in your setup there. What people talk about when they talk about the 60-40 is probably benchmark, broad-based, whether total stock market or the S&P 500 or, something that's probably more heavily dominated by, blue chip, broad-based kind of stock market.
Not individual stock picks in this case.
And then with the same idea with the aggregate bond index, the U.S. Aggregate bond index, which, I think the way we've tried to invest, we tried to be more nuanced, be more deliberate in how we structured our portfolio. We had notably less duration, which is to say interest rate risk, in the way we were trying to structure our bonds and for our clientele. So, there is the way I might think about it may be different about than what this benchmark kind of approach was. But let's talk about it more from that broad-based perspective. A duration, that the broad-based benchmark on the bonds is in a position to have a decent yield and, less worry based on what we expect for interest rate movements, 0.5% kind of ballpark. You're going to be able to absorb that price impact with the income you're getting. And then if there is movement in the other direction over time during the year or whatever it might be, you're likely to be benefited where you're actually seeing price improvement, prices rise on your bonds. And, I think it's going to be a story where investors are going to be looking to increase their duration, the terms, the interest rate risk, if you will, on their bonds over the course of 2023, which will likely mean better yields for longer term, right? If the shorter term gets more affected by changes in direction, for the yield it might generate, maybe not as much for the price, but the income. So we want to be in a position where maybe we want to extend that duration and start thinking again of having some of these bonds that will pay that income longer,
locking that in, right?
locking that in, you know.
And I think we'll see that happening, and the listeners can see it happening when they're looking at the bond yields. Right now, they're inverted, meaning the 2-year is paying greater rate than the 5, 10, or 30-year. When those start to become normalized with longer bonds paying higher rates than the shorter bonds, you'll know that you're getting back into it.
You're benefited, and you're likely to be seeing, as there is some rate movement, if the expectation that future rates may be a little lower than current rates, as that works into it, you're likely to see price benefit. So I think that so that's one aspect of it. And then when you look at stocks, the question for the stock side of it is, will in talking about, we talked about the forward-looking PE, price earnings ratio, and how the multiple is reasonable. We're at a reasonable valuation for where we stand today, in line with a long-term average. The question on everyone's mind is, will a recession undermine the E?
The earnings.
The earnings. Will earnings decline, and how much? Will it be to a point that it undermines the potential for some, growth in the market, or not? And I think by and large, it's expected that any recession we might have will be shallow and short, so that it's not likely to be as, you might discount earnings. Brian generally discounts earnings when doing these kinds of estimates for our, projections as to, how do we think about valuations? Because it's very common that, at the start of the year, earning estimates are higher than they actually turn out to be at the end of the year. So you kind of have to discount that a little bit anyway. But it's a really question of how much will earnings be undermined by any economic, disruption that I think generally we all think is likely to happen. So I think there's probably some room for optimism in stocks, but it's a tempered optimism for 2023. We shouldn't be saying, oh, gangbusters, but maybe that there's positive returns that we expect, and ultimately, longer term, there's a lot of companies that look really attractive today.
Exactly.
And so it's a matter of trying to find, where do we want to put our emphasis, I think, in this environment. Active management may be at a moment in time when it will, again, show its worth, when over maybe the past couple decades, we've been kind of mindful of, passive investing has really been where it's at. It's been pretty effective. I think we're in a moment when active management, the selection process, could be that much more important than just mere participation.
I completely agree, and it would be nice to be in a market where earnings were driving the price rather than, let's face it, the COVID and the response to COVID, the stimulus, and then the inflation and the Fed action have been driving the markets more than actual earnings. It's been more of a broader base, but just starting next week, we'll have earnings season again, right?
Yeah.
And a lot of companies are coming out. So I think we'll start to get an initial look at the last quarter of last year and the earnings. And, it's at the end of the day, people buy stocks because of their future earnings potential or the income that they produce. And once inflation's under control and the Fed is more on the sidelines of this, it's going to be earnings that drive the price of stocks, hopefully.
Yeah, good point. Let's use that as a good point to take a pause. We need to take a break. More to come with something more with Chris Boyd and Jeff Perry with me today, both of us from Asset Management Resources. Stay with us. We'll be right back after this. Guarantee isn't a four-letter word, but cost is. Market volatility is challenging, but with time generally leads to superior returns. Annuity products with guarantees can sound appealing, but they often come with a very high price tag and significant sales commissions. With a higher interest rate environment, bonds of all kinds are paying more than just a year ago. Is your portfolio positioned well? Hi everybody, Chris Boyd here with something more for your financial well-being. We at AMR are offering investors with investable assets of $500,000 or more a complimentary portfolio review. Isn't it time you worked with a local experienced fiduciary? Meet with a professional you can trust without fear of product sales or costly commissions. Call us at 508-771-8900 or check out our website amrfinancial.com. That's amrfinancial.com. Asset Management Resources for those intent on a secure retirement. Welcome back to Something More with Chris Boyd. I'm here with Jeff Perry. We're both from Asset Management Resources. Thanks for listening each week. And again, if you don't get a chance to hear the show, we do publish it on podcast. We notify everyone through our social media involvements, and we've got a whole bunch of them. So if you want to follow us on social media, we're probably on Facebook or LinkedIn or Twitter, Instagram, YouTube, whatever you might be following. We could probably keep you informed.
But not on TikTok, though.
Not on TikTok. That's right.
No. I think we'll skip that.
I'm really questioning whether I want to stay on Twitter as well.
I think a lot of people are just wondering what Twitter's ultimately going to be, right?
Yeah. Whether it will be I think a lot of people get information through people's tweets and so forth.
Mm-hmm.
But at the same time, the way they're sort of, I think Musk is saying, we want to have no barriers to people's views. But I think there runs a risk that could become a source of disinformation and somewhat not so much civilized discourse.
He's struggling with that. It's a couple weeks ago he banned 4 people who were basically identifying his location. And he banned them. He said out of safety. But so it's like the famous Supreme Court cases, like on free speech. Free speech is great, but you can't yell fire in a crowded theater, right? You can stand up in the town square, but you can't incite a riot. Maybe that's an interesting political example.
I totally think it's a challenge. On its face, it's a good thing to have free speech, right? And to have no guardrails. On the other hand, there are some risks with a platform like this, with some of that. So anyway, I guess it's one of those stand by. Stand by. Let's keep.
That's
watching.
What I'm doing. I've never been a big fan of Twitter, but I'm there. I look at it. I post once in a while. So I'm in your camp. I'm waiting to see what it turns out to be. Hopefully it's better. It's better.
Yeah, exactly. That remains to be seen. Be interesting to see how it develops. So in any case, a little sidetrack there, but follow us on social media if you'd like to connect and be informed of when we have events, or certainly each week we post our podcasts. That's Armin's gig. So thanks for that too, Armin. So last hour we were talking about the 60-40 portfolio and how bonds are invested. Where should we pick up our conversation? Where did we leave off?
I completely agree with your comments. They were in line with my comments and many others. But, to be frank, some people, very, very known names out there in the investment world are saying that bonds have no place in your portfolio.
It's nonsense. Bologna sauce.
I didn't know Brian was on the show today.
We didn't have Brian on the show today.
I agree. It is bologna sauce. They do have a place. And I think in 2023, their place has been reestablished. And, we agree. So what can we say?
Yeah, I think that's it's not certainly the point I would make, although I think, if you're a listener to radio programs and financial talk, you'll probably hear that argument being made by people promoting product sales. And oftentimes,
Good point.
fixed annuities come to mind as, and candidly, a fixed annuity today does have some appeal with higher yields, higher rates than they used to have. Just the thing to keep in mind, and there is essentially stability of price in effect. Essentially, it's all happening behind the scenes. The insurance companies taking the risk, and just little common sense question for you: if they're taking the risk, do you think that they're going to do that for free? I don't think so.
We know the answer. No.
Yeah. So they're probably doing things in a way that they're making some money on the deal, and you're probably making a little less than what you might be able to do if you're doing it, invested in a way that it might be diversified and so forth. So
they don't put those names on stadiums and big buildings with money that they lost.
Yeah, right. So, I just think there's other places to get those kinds of returns and performances as well. That being said, as a piece of a pie, can there be a place for these kinds of, in the portfolio because there's some stability and some, aspects of that might have appeal? There can be. But keep in mind, you can really replicate a lot of that by doing it. As you said earlier, Jeff, if people have individual bonds as an example, they know what they're going to get for that return from start to finish. They don't have to necessarily sell and so forth. And so there's whether it's governments, corporations, or other entities, there's ways to get similar kinds of returns. Be careful of surrender charges. If you examine a fixed annuity as an example, be careful of surrender charges. They can be very long, and it affects the commission that the individual is being paid to sell you that product. Oftentimes, the people in these kinds of environments, following a year like we just had, or in the midst of a year like we just had, people will be interested in products that have an apparent guarantee. I can participate in the market but not have risk of loss. Well, does that sound too good to be true? It is. It's not that you're going to have full participation in the market, but just not when it goes down. You're going to have some measure of participation, and those goalposts move from one year to another year.
Right.
And how much participation, how it works, it's very convoluted. And candidly, it's something to be careful of. So that may be another example of something where someone wants a second opinion. Take advantage of our complimentary portfolio review. We mentioned it in the last hour. I'll mention it quickly again. We're offering a complimentary portfolio review to people who would like to get kind of a second opinion on what they're doing, see if it's anything we can offer any observations around. We do a 2-meeting process where we invite you in. We gather all your data. We learn about what your priorities are, what's working, what's not, from your concerns. We do an analysis. We make recommendations and observations for you. It's up to you whether you take them or not. And it gives you an opportunity to sort of kick the tires with AMR. Who are they? How do they work? We might be a good fit for you, may not be. But we generally offer this to people who have a portfolio of $500,000 or more, and we'd love to have you take advantage of it as an opportunity to see if things are working the way you want them to, and if not, maybe there's some ideas that you can take away from that. And if you're in the market for finding a firm that you might work with ongoing, it would give you an opportunity to see if we're a good fit for you in that process as well. There's no obligation, though. If you decide you just want to get some information, you're totally welcome to do that too. So in any case, take advantage of that by reaching out to us by phone, 866-771-8901. You can text us for the offer at 508-915-3700, or reach out to us through our website, amrfinancial.com. Sorry,
Chris,
I got a little sidetracked there.
Can I add something to that? Because I think it's important, and whoever you work with, whoever you are working with now or whoever you work in the future, I just strongly encourage you to ensure that they're a fiduciary. A fiduciary is someone that is legally and morally required to work in your best interest, not on their best interest. they make advice to you, it's supposed to be to your benefit, not for how much they're going to make. And ask whoever it is, your current advisor or someone new, ask them if they're a fiduciary. And you should also ask them how they're paid, how they're compensated. And they should be able to say yes, they're a fiduciary if they are, or no, that they're not, and how they're compensated. And during your interaction with whoever you're working with, see if they're talking more or listening more. Because if anyone's going to help you with develop
That's
a financial
really interesting
plan,
observation. Yeah, I like that.
If you feel like they're doing all the talking, in other words, they may not feel like it if they're experienced, but they're selling.
Yeah.
And they don't know who you are, what you have, what your fears are, what your goals are, what your dreams are, everything that encompasses your financial life. How can they make a suggestion? That's why when Chris was talking about our process, it's a two-step process. The first step is to get to know you. The entire meeting is about you. It's not about us. It's about you and all those things. And we don't make any recommendations until we've gotten to know you in that first meeting, talked as a team about you, and then come back and make recommendations that we think would enhance your ability to achieve your goals and dreams. So are they a fiduciary? How are they paid? And are they listening to you, or are they just selling you?
Yeah, that's a great observation, Jeff. I appreciate you adding that. It's some stuff I take for granted that this is how we operate, and
I know,
you kind of forget that's not how necessarily everyone structures their approach. So, in any case, we welcome you to take advantage of it. Hope you will. So, and we don't do this all year long. We really kind of do this as a January offer. And then we kind of, we won't be doing it forever, because there's only so
we
many.
couldn't do it all year long. That's all we'd be doing.
Yeah, exactly. So take advantage of it now. Jump while the opportunity exists. It's one of those things you probably a lot of people out there. If this resonates with you, it's one of those things you've been thinking about doing. You should really take advantage of it while you can. Whether or not we're the right fit, that's an opportunity for you to evaluate. But at least you can get some direction, maybe some good advice, a couple of nuggets that you can benefit from. Take advantage of it if it could be of help. In any case, we were talking about income investing a little bit.
Yeah, can we go back to that for a minute? Because we spent a lot of time on bonds. Sometimes people who are kind of looking for growth and like to be in the stock market also look to dividends in the stock. So what do you think about buying stocks who, for dividend reasons, buying stocks who have an opportunity for growth but also provide a current dividend?
By and large, our approach has been focused primarily on total return. We're less focused on where that return comes from, whether it's in the form of dividend income, whether it's in the form of appreciation. There's reasons to buy different kinds of stocks in a portfolio. We want a diversified portfolio, but on the whole, our base case approach is not purely for income. And there are sometimes risks when people go in search of income.
Absolutely.
Because you can end up finding that if the income is high, oftentimes there's a risk that the company is not doing well. And, it's not to say that it's absolute, but, there are certain kinds of stocks that tend to give more in the form of consistency of income than maybe price appreciation, and they might have greater stability and there can be reasons that they can have a lot of attractive qualities.
People think utilities when you say that, right?
Yeah, it's a good example. Utilities, phone companies, things like that.
Well, I'm going to make a side note on a phone company, because a lot of people owned AT&T for the dividends, because they worked, and a lot of those people worked for AT&T, acquired stock, and kept it thinking that it's a low risk because it's had at the end there, about a 5% dividend, which was great, right?
Yep.
But that dividend is gone. If you were just looking, to your point, and using AT&T as an example,
that was where I was going with this. You totally
go right ahead.
No, please
go
go.
ahead.
You got it. You're doing great. But that was exactly kind of what a good example I thought we should
Right.
kind of include in this.
Yeah, it's if you weren't watching the balance sheet, if you weren't watching the revenue, if you weren't seeing if the company was healthy enough to support that dividend, and analyzing the board meetings and the trend of the company, the growth of the company, meaning is the board going to decide to maintain this dividend? Because if you were studying this company, which who wants to do that all the time, right? Except for us. If you they were sending signals like, well, we might have to cut this dividend. We might have to cut this dividend. And they were also sending mixed signals that they weren't going to. So it was when they did cut the dividend, it was quite a controversial move because there had been so many legacy owners, meaning people and or mutual funds or investors or individuals or employees who had held AT&T not for growth, but for that dividend.
So, that's a good example, though. There can be instances when a company has a very attractive dividend that it can point to underlying stresses, and oftentimes there can be a cut to that dividend, and that can be painful for an investor because you're largely, you're not getting it for price movement, and that can affect the price adversely when
did
the
affect
income goes down.
You lost the dividend, and because people were selling it because they lost the dividend, the price went down as well.
Yeah.
So you get hit twice.
So, but that's not to say all income investing is of no benefit. I'm not making that point at all. I'm just saying there are times when that income looks very good. It can be an indication of concerns, right? And we have to be more careful when we are in search of that income stream. So, in an environment where there's income options, right? Dividend investing can have a place. And I think sometimes retirees tend to think in terms of, I'm going to use dividends as the way from stocks, as the way I'm going to generate or receive my funds from my stocks. And as opposed to being willing to sell a little bit from appreciation, what I start off saying, we're total return kind of mindset. We're agnostic about whether it's from income or from appreciation. There's a place for both in a portfolio. We generally try to structure a portfolio where there is some varying characteristics in the way we structure. But that being said, in 2022, companies that had more cash flow, more income, more dividend, let's call them value stocks generally, held up better.
They did.
And which, after a bit more or less a decade of growth outperforming value, and historically value and growth kind of have competed, back and forth from period of time to, next period of time. So, I think generally though, it was good to see value have its day to some extent. And again, explains why generally we want a diversified approach to a portfolio. I think one of the things that a lesson from last year, given the opportunity, I think it would have been better to be a little more tactical in that balance decision of, whether to be, a little weighted one side of the growth value picture over another. We were pretty balanced. I think maybe it would have been better to be a little more tactical in that decision. To have had we had the benefit of hindsight, that probably would have been something we'd do a little bit differently today. But I think on the whole, I see the appeal to people. We do have an offering where it's a dividend-oriented strategy, because there are people that really are attracted to this approach. Ours is not purely an income play. As I say, we want to have some representation of growth and value. But these are the things to consider when you're structuring a portfolio. We probably have more to talk about on the dividend topic, but we've run a little long on this segment, Jeff. Let's come back and talk more about this a little bit. Okay, we'll be right back after this. As a fiduciary, AMR is a financial planning-based wealth manager. Providing comprehensive financial planning, we take time to understand your goals and dreams, then map out a financial pathway to achieve them. For most, that also entails consolidating investment accounts and providing discretionary portfolio management tailored to your temperament, informed by your financial planning priorities. AMR is compensated by our clients, not through product sales or commissions. Hi, everybody. Chris Boyd here, founder of Asset Management Resources, with something more for your financial well-being. Let our team of qualified fiduciary professionals help you on your life's financial journey. Benefit from our comprehensive complimentary portfolio review to start the new year. Call us at 508-771-8900 or visit amrfinancial.com. That's amrfinancial.com. Asset Management Resources, for those intent on a secure retirement. Welcome back to our final segment of Something More with Chris Boyd. Jeff Perry and I have been talking about a variety of things as relates to investments this week, but most recently income investing, thinking in terms of not only bonds that we talked about earlier in the hour, but from stocks. Stocks produce income as well in many instances. I kind of went on a rant there, Jeff.
I wouldn't describe that a rant.
I just kept rant, maybe more of a ramble.
It was a reflection.
All right, I appreciate that kindness. So, in any case, what were your thoughts about this topic of thinking about dividend investing? There's things to like about it, but there are certainly pitfalls to be mindful of.
I really like dividend investing, and if you're younger, I think it has a place, especially if you reinvest those dividends and acquire additional shares of the underlying investment.
Back to Jeremy Siegel.
Absolutely.
Stocks for the long run. And his book about dividend reinvestment, huge impact over time.
So back in the 1990s, early 1990s, I joined the National Association of Investing Clubs, and we had an investment club, and we studied stocks and we reinvested dividends and learned a lot about it. Now, what I was doing wrong then, I didn't realize, and we did fine with it, but the risk that I took is I was buying individual stocks and participating in their DRIPs, their dividend reinvestment programs. So I think what all of this exposes is, meaning 2022, our AT&T example, is that if you're going to be a dividend equity investor, especially, the stocks that you select should be professionally managed, so that those things that we were looking at with AT&T that happened, meaning the dividend went away and the share price went down. If you have someone professionally managing a portfolio of dividend-producing stocks, so by doing that, you get that professional management, and that manager is looking for risks in those investments and opportunities in others, and you don't have that single stock risk, which if you owned AT&T, you suffered. And it just highlights, one of the biggest benefit of working with someone is that you can have a tactical, strategic, diversified portfolio that's managed, so when things come up, you can take advantage of the edges, and you can make sure that you're invested, you're allocated the way you want to be allocated, so with an eye towards your financial goals, your income needed, your spending, your legacy, whatever it is that's important to you. So all of this discussion is great when you're thinking about income, but when you put it back in the context of risk, single stock risk, I guess, mostly. And the plan, right?
Yeah.
And how it fits into it is the most important thing to me. Be diversified and accept professional management, especially when you're doing something like dividend equity investing.
It's a really good point that, as individual investors who've had, individual stocks that have done well, they tend to not sell them. They tend to
they get emotional, right? They get attached.
They get attached to them, right? And they say, "Oh, it's been good to me." And so there's sort of a blind spot at times when as they think about that, they don't necessarily right size those positions over time. To even if you want to have that as a healthy position in your portfolio, there's a limit to how much you want any one position to be more broadly diversified. AT&T is a great example of people who had it over many years, that they also have a whole bunch of other companies that might be in the same industry or related industries.
Or their pensions tied to AT&T or
yeah, and that
whatever.
could be, doesn't matter what company, but if you're
Right.
a company stock, it's not only your income, but your asset, and that can be a risk. So there are reasons to think about this, and sometimes a third party, an outside set of eyes, can point some of these things out in a way that you go, oh, yeah, that's an interesting point. More importantly, I think, though, to your point about the assessment of individual securities, the way an analyst evaluates a security is very different from what typically an individual does on their own. They're more dispassionate. They're looking at the financials, the fundamentals of the company, and evaluating growth prospects, future earnings opportunities. It's a very different mindset, and it is something that is a skill. It really is a skill that really does have value in the sense that it can help you to move away from things when they are just not representing the opportunity, even if they did once. And,
Absolutely.
And that can mean tax consequences. It can be unpleasant in some regards, but better to pay taxes and retain value.
Mm-hmm.
We don't aspire to not having to pay taxes on stocks because they didn't make money. Do you know what I mean?
I completely agree. And it is one of the taxes is one of those things that people are some people are so adverse to that they will, as you said, hold something longer than they should just because they don't want to pay the taxes. It's not wholly rational, but it happens so much we have to acknowledge it.
And there's also other mindsets of, oh, well, it's down and I won't sell it until I get back to, a certain mindset. It's the opportunity cost is also there. What would I alternatively be doing with that money that might get me an opportunity to recover faster? There's a whole mindset that's hard to evaluate, but sometimes it really does. One benefits from having a little bit of help in the process.
Objective help, right?
Yeah. And to your point earlier, make sure you're dealing with a fiduciary.
Mm-hmm.
So, Jeff, I guess we're basically down to a minute. Parting thoughts?
We're not done. We have more.
We had one more thing we wanted to talk about, right?
We'll
which we mentioned earlier at the start. Yeah,
maybe we'll put that on the top of the list for next week. Unless we have something new and exciting that comes up that we have to talk about. You never know.
Yeah,
you should tune in and you'll hear us next week.
Jeff, thanks for being here throughout the show. Great stuff. Appreciate all you brought to it. Listeners, thank you for being with us. Take advantage of our complimentary offer. If we can be of help to you, reach out to us through our website, amrfinancial.com. Give us a call, 866-771-8901, or you can always text us and mention the offer, 508-915-3700. We hope we can be of help to you as you think about your financial planning and portfolio management needs. In any case, again, we're offering a 2-meeting process for a complimentary portfolio review. All right, well, that's it for this week of Something More with Chris Boyd. Until next week, keep striving for something more.
I'd be rich.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.